Hello, I'm Colin Anthony, General Manager of Intellidex. At this company, we really expect the tax-free savings account to have a huge impact on the South African market. The concept has already been introduced in the UK, and our Chairman, Stuart Theobald, has done quite a bit of research into that market, and he's here to tell us a little bit about it. What kind of impact did it have in the UK, Stuart?
So the National Treasury has looked at the UK equivalent, which is called an individual savings account, or people just talk about ISAs. And that's really given the National Treasury a lot of guidance as to how to structure tax-free savings accounts in South Africa. So it's very interesting, I thought, to go and have a look at what the experience in the UK has been, because they were introduced there over 15 years ago. So there's been a market acceptance and evolution as to how they're being used. I mean, the first interesting point to think about is when they were introduced in the UK, the limits that were applied. So in South Africa, we have 30,000 Rand a year is the limit that Treasury started off with. In the UK, limits were higher than that, but they were still quite low. And then they accelerated quite rapidly after that. So each year, limits were increased to the point where currently in the UK, the limit is £15,000. So that's the equivalent of about 270,000 Rand. Almost 10 times what we're allowed to invest into these accounts here.
And you expect the same progression in South Africa, raising the limits periodically over time?
I think absolutely. I think Treasury doesn't want to start out with anything too big. They want to see what the impact on the tax take is and how people use the accounts. But if people are not saving at the 30,000 Rand limit anyway, so if they save less than 30,000 Rand a year, which when you look at what happens in the UK, is probably what's going to happen here. So people will save even 10,000 Rand a year or less. Then in those cases, having a 30,000 Rand limit doesn't really do anything. So increasing the limit doesn't necessarily mean you get a substantially greater savings.
It won't be a flood into, yeah.
Absolutely, and that consequently means that you're not really losing out on much tax. And if the savings accounts work as planned and stimulate more savings, the net impact on the economy is positive, and therefore the net impact on the tax take can be positive.
And were there any other barriers or negative factors in the UK that they had to sort of twitch and tweak that we might experience some similar issues here?
And one of the things that was important is how do providers charge for these accounts. So initially, providers put ISAs into the market that had specific ISA charges to them. So there was this assumption that somehow, because it's an ISA and you're saving tax, it therefore makes sense for us to charge you something extra for them. That's how providers started out, but it quickly happened that competitors came to the market and said, well, we're not going to charge you extra just because this is an ISA. And as a result of that, the marketplace sorted itself out, and competitive pressure now means that there aren't, very often at least, additional charges for an ISA. So I think that's something that South African financial services providers will hopefully take note of, that a tax-free account isn't something that you can add an extra charge onto. In fact, probably the opposite. It's something you should be providing at lower cost than other savings products that are out there.
One of the restrictions we've got here initially is that you can't invest directly on the JSE through your account. What did the UK do? Did they have that restriction at all?
No, so that's an interesting difference. In South Africa, you can invest on the JSE, but you have to use a different kind of vehicle. So an exchange-traded fund is the most common one. And those are really funds that are invested in a whole pool of different shares that you then trade shares in that fund on the JSE. So that way you can get direct access
and through
to
unit
JSE.
Trust, of course.
And through unit trust,
yeah.
which might be
But
invested on the JSE.
trading?
Holding individual equities is where tax-free savings account are very different to ISAs. ISAs in the UK, you can hold shares. So a lot of people will hold their share portfolios in an ISA structure. Whereas in South Africa, you won't be able to do that. You'll be able to hold exchange-traded funds in a tax-free savings account, but not individual shares. Now, we'll see what happens. This is another area where the regulations around these accounts could develop, and in time, Treasury might drop that requirement, or at least drop it for the JSE top 40 companies or something along those lines.
Do you know if the UK have experienced any negative consequences of allowing direct share trading?
Not that we can tell.
Yeah.
I think the fear in Treasury is that people would be irresponsible in what kind of shares they'd invest in, that they'd choose particularly high risk, volatile stocks that might wipe out their capital.
They were also scared of churning high turnover stuff,
Yeah.
trading on opportunities,
Yeah,
spec trading.
So you get clients who might end up burning a lot of money just in transaction fees because they trade too frequently. So those kinds of problems can happen. But people are not that dumb, really. Certain types of behavior are going to be bad for your returns, and that alone is a good reason for you to not engage in that sort of behavior. And if you look in the UK, people hold their ISAs as long-term portfolios, so that's the right investment strategy for this kind of product, that you want to be investing in good quality shares that you can hold for a long term.
It's a long-term.
Absolutely. I mean, people should be using these accounts to assure their financial security for many years, and that's the way it's been done in the UK. And the structure of the accounts is meant to drive that sort of behavior, because once you draw money out of the account, you lose the tax protection that the returns on that money is going to get you in that account.
And in terms of take-up there, critical mass, has it reached, is it very, very overused, not overused, well-used facility?
So in the UK, the types of ISAs are split between two basic types. One is a cash ISA and one is a share ISA.
Oh.
Now in South Africa, we're only talking about tax-free savings accounts in which you can hold cash vehicles like fixed deposits, or you can hold equity vehicles like some unit trusts or exchange-traded funds.
Okay.
So in the UK, the cash ISAs have proved more popular. Every year, about 11 million of those kinds of accounts are sold, compared to about 3 million share equity types of accounts. But the regulatory evolution is such that the difference between those is now collapsing, because you can just hold cash in a share account anyway. So you might as well just have that single account, and there's no difference between your limits and so on over how you try to do it. So it's interesting that cash ISAs have been more popular than share accounts, but one of the main reasons for that is the tax system in the UK is quite different here, in that your only way you can get an exemption on interest is to hold an ISA, whereas in South Africa you still have, I think it's around 30,000 Rand a year exemption from tax on interest. So you can earn up to 30,000 Rand of interest a year tax-free anyway. You don't need a tax-free savings account for that. In the UK, you can't do that. You have to have an ISA in order to get interest tax-free. So that's a big difference between the UK, and that's why
having one product here is probably a lot more beneficial.
it's a lot simpler, a lot easier to understand. But it's also why in the UK there's a bias towards people holding ISAs that are cash ISAs rather than share ISAs. In South Africa, the tax system is actually the opposite way around, the effect, because you can have an interest-free, an interest
Cash
exemption, so you don't need a tax-free savings account for that. However, dividend tax is going to apply to any shares that you hold in any portfolio. So the only way for you to avoid dividend tax is to hold a tax-free savings account. So the tax incentives drive people more towards holding share-type instruments in South Africa, whereas in the UK it drives people more towards holding cash-type instruments in ISAs. So that's a different element of the market. But the bottom line in the UK is around 13 million ISAs are sold every single year in a population of about 60 to 70 million people. We have half that population. Obviously our GDP per capita is lower, so we would expect a lower proportion of the population to invest. But if you start to extrapolate from those numbers, there are potentially millions of South Africans who could be taking up tax-free savings accounts.
Any other lessons we learned from the England experience for us?
Well, there's also some lessons to learn in how the accounts are marketed. So what tends to happen is at the anniversary of the tax year, so our tax year is the end of February, you're going to lose that 30,000 Rand allowance that you have. Right. So providers tend to go out towards the end of the tax year and aggressively market to people to say, hey, don't lose that allowance. Put your 30,000 Rand in a tax-free account before the tax year expires, because then you've lost that 30,000 Rand allowance forever. That's the way people behave. They're lazy until that deadline is right upon them, and then they'll suddenly go and do it. If they were more sensible, you would get your money in on the very first day of the tax year, because then you've got a whole year of interest that's going to be earned tax-free, interest or other returns that you're getting tax-free in the account. So if you're a sensible saver, go in on the first day of the tax year. Don't wait for the providers or for the rush right at the end.
Thank you very much.